Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the TGI. Thank God it's Friday, the 7th of June, Bull versus Bear webinar. Steve Miley here on the call as ever for Trade Day. Welcome, everyone. Apologies we couldn't make the webinar yesterday. I had an appointment, so unable to deliver the webinar, but nonetheless, here we are on Friday and TGI Friday. So we're going to go for our usual regular run through in here. Today we're going to take a look at the calendar, what we've had, what we have got coming up. We'll take a look at some articles from the major news wires. We'll take a look at articles and major news. We'll take a look at what's going on the overnight, and then we'll also take a look at the actual markets, what's happening on the charts for you guys right here, right now. Okay, so let's start by looking back before we look forward. So first of all, yesterday, ECB cut rates as anticipated in here. But you would kind of class it as more like a hawkish cut. So they did cut rates, but kind of the guidance wasn't particularly that, this is the start of a load of new rate cuts, etc., etc. So, it was because probably more in an effect of a hawkish cut. We didn't really expect them to be overly dovish anyway. So the market kind of there were reactions, but not a huge reaction. It was kind of choppy on the European bond markets yesterday, rather than being just going to either higher or lower yields. So we had that yesterday. So but delivering another rate cut, having had the Bank of Canada cut earlier in the week, and then the ECB cutting. That's two central banks this week. And then there is still some hopes in here, even though like the markets are pricing in September. We'll talk about shortly. There are some major houses, investment houses, investment banks that are calling for potentially still an earlier rate cut, and we'll just touch on that shortly as we go forward. Overnight as well, significant data out of China. Trade data is always important out of China, obviously. The factory of the world in here. So trade data always important, more so than most other countries for China. And you can see we have it's some in line with expectations, but overall a slight greens in here, so slightly better than expectations. Certainly exports in here, even though this is not actually flagged in green or red, exports higher than anticipated in here. So that's certainly a positive, and got a little article on that as we go forward. Moving on to today, obviously all eyes are going to be on the jobs report. We have had some German data in here this morning. The trade data not so important, more significant in here, the industrial production data. Slight miss on the German industrial production data in here this morning. And then winding forward, we do get GDP in here. We had the GDP, excuse me. GDP data already out, bang in line with expectations with the Eurozone, and the employment change, bang in line with expectations. So no real big shakes there from the European situation. So all eyes on the employment report today in just under 1 hour. Now, do remember, no trading 2 minutes before or after the employment data. It's one of our flagged economic data piece events where you cannot trade 2 minutes before or 2 minutes after. No trading 2 minutes before or after. No orders in the order book either, because you can get hit on an order, right? So with no orders in the order books 2 minutes before or after, and no trading obviously during those 2 minutes. 2 minutes before the announcement and 2 minutes after the announcement, which comes up in now just 57 minutes time. So we do have the employment report. All eyes are going to be on that. The market's clearly going to react to that. Now, kind of maybe counterintuitively, a slightly weak report could be a positive. Okay, a slightly weak report could be a positive in here for the market. So certainly watching out for that. It's the fact that a slightly weak report could mean that it implies that we would have a slowing economy. A slowing economy then would then indicate potentially the Fed could actually then be looking to maybe cut rates earlier or more aggressively than anticipated. So certainly bear that in mind. A weak data could actually be, you might get a knee jerk. The algos might initially see the market move in one direction and then could potentially reverse back in the other direction. So watching out for that today. The employment report coming up. Also the Canadian employment report, but obviously all eyes really going to be on the US report in here. So watching out for that. And again, it could be counterintuitively. David's answering. The rest of you can hear me, right? I see Jim and Stefano, you've checked in. I'm assuming David can't hear. You can hear me, Jim and Stefano, right? And anyone else on the call? Jim and Stefano, you can hear me, yeah? Right? I'm hoping. Okay. Oh, good. Okay, so they can hear. So yes. So okay, cool. Sorry. I mean, I think David. I think it's probably a problem with because you let them know, guys. David know that it's probably a problem at his end. Thank you for that, guys. Right. Okay, I'll carry on. So yeah, all eyes on the employment report, basically. Right. Let's just run through a few of the articles in here. ECB official get cautious as on more cuts as wages pick up. So return to watchful phase on inflation. So cut. It might be like one and done. You know, is what the phrase often uses, one and done, but maybe not one and completely done. But they're not setting in stone that you're setting a path to more interest rate cuts. And then I've also got in here, actually we'll come to this, run through 5 things to start your day now. So all eyes on employment, we've already spoken about that. In here, rate cut expectation has escalated in the past week. I just slew of weaker than forecast US data. So again, look, weaker than expected data in here. Weaker than expected data implies then potentially upside. Yeah, okay, so more rate cut expectations, and then potential for earlier rate cuts or more aggressive rate cuts, and then that leads to potential upside for stocks. Okay, so a weaker than expected number might actually, as it has been this week, has led to actual upside in stocks, kind of sort of counterintuitively. Growing optimism over rate cuts propelled global bonds to post their longest winning streak. So bonds are up in here, longest winning streak since November. China's central bank didn't buy any gold last month. That's not really affecting us unless you are trading gold. And then much to the worry of US commercial property. Okay, that's not really affecting us in here. So again, all eyes on employment report in here, and then the Fed are obviously on blackout as well. So remember, it's Fed next week. JP Morgan and Citigroup are among the few banks assuming the Fed will ease next month. Okay, not this month, not June, at the July meeting. So there is maybe an expectation on that. And there's something on here. I've got an article on here as well. So global stock rally falters ahead of US jobs. So yeah, it falters, but not really going down, right? We had a strong rally back on Wednesday, and the market kind of just sat there and marked time yesterday, sitting right up at the highs. And an overnight in here, markets holding on to gain. So looking positive, poised at the highs. That's a sign to me that the risk is still skewed to the upside. Stock market rally pauses as US jobs data looms in here. All the same stuff in here. US check on sub 4% jobless. Okay, so that's the question as well on the unemployment rate in here. The monthly rise in average earnings, we're looking for that as well. And then unemployment rate set to remain at 3.9. Holds Deutsche Bank strategy point out we mark 28th month below 4%, the longest such stretch since the 1950s. So unemployment stays very much in check in here. Futures steady, all the same stuff in here. Here's the article: JP Morgan Citi still betting on a July rate cut in here. So very dovish, compared to what the market has not ceased pricing a July rate cut since April, and now we're really now pricing in a September rate cut in here. US stock rally faces risk from weaker economy. So again, Citi pointing out the slowdown in the economy. Okay, is the US stock rally could be derailed by a weaker economy, but then obviously weaker economy could mean that the Fed become more dovish, and if they do that, then we could see stocks higher as well. So there's certainly some flags in here coming out of Citigroup. On the Fed Watch tool in here, we've been looking at this little changed in here. If anything, though, this is ticking higher. So if we go to September on the historical, and we look at the one rate cut in here, which is the 500, 525. You can see in here it's continue. Oops, let's get rid of that one as well. Where is it? So continue to push higher. We had a little bit dip back lower yesterday, but throughout this last week or so in here, pushing higher to higher. More chance of a rate cut coming in the September meeting. And if you go to the December meeting, and the same thing in here, but looking at the 2 rate cuts by December now, that's the 475, 500 in here. And watch us again in here. That's kind of flattened out a little bit the last couple of days, but it's been rising in here throughout June into its highest level. So we are at the market is pricing in its most dovish point it's been in here for certainly some time. Quick look on the overnights in here. Asian stock indices, Hang Seng. Sorry, the Nikkei was a little change with 0.6 down on the Hang Seng. European stocks are actually lower in here this morning. The FTSE 100 nearly 0.6. the DAX and the German DAX and the French CAC now nearly down 1% between them. And then US futures having kind of marked time yesterday, again marking time in it going into the day. S&P 500 little changed as we go into the day, just hovering right at those peaks in here. What else have I got for you? But this has been the big move. The real big move has been this big move down to lower yields. Yesterday we kind of marked time at these new low yields in here, but this significant move to lower yields still pointing down, lower in yields, higher in price in here. And there's the bond markets in here. We're still bullish in here. We just cleared this peak in here. You've got this kind of double bottom now, big double bottom, having had this trend line reversal, big double bottom there. So bond markets are pushing higher in, aiming technically higher in price, lower in yields. Okay, so that still remains, and higher bond prices, lower yields should be good for stock indices, particularly for the Nasdaq. And you can see in here markets, from the overnights in here, just sitting right up, having cleared to new highs, just made new highs above the S&P and the Nasdaq in here. Well, S&P just sitting at the new highs, right? But the Nasdaq making new highs in here. And if we go and take a look at the charts in here, you can see there's the Nasdaq way through. Wednesday's surge higher in here, marking time, nudge higher, consolidation day ahead of the employment report. For me, this all says that there's that the risk is up, right? But again, it's all going to be on the data. If the data is strong, I think counterintuitively we sell off, okay, initially, but I think it's a buy opportunity. If the data is weak, okay, then the market might rally and continue that rally. I think the week we just see straight up. I think if the data is strong, unless it's really strong, I think we initially pull back and then it's a buy on that. So that will be my take going into today. And the ES in here has just nudged above the recent peaks yesterday. The peaks from back here at the end of May, and again sitting strong up here yesterday. High level consolidation, all pointing higher. So I think it was the other day. I'm not sure if the David who's asked the question, because I see the two Davids we've got in here. One is a capital D and one is not a capital D. So I think there's two Davids on the call. But David who asked a question, market charts for resistance support section. Green figures are resistant levels. Perhaps that should be clarified in the report itself. Also, what is a bull fade? I do not believe this was covered in the trainings. Okay, David, I think I haven't really got time to go into all that in here at the moment. Maybe drop me an email, send an email to support at Trade Day and ask to escalate to Steve and I can answer that. But basically, yeah, I mean, the levels, I think it's, well, for me, it's fairly explanatory. The levels above, if you break through the levels above, the levels above are clearly resistance. The levels below are support. So if they're below the market, they're support levels. If they're above the market in here, they're resistance levels. Okay, and if you want to, I'm not going to go into a bull fade, etc. But if you want to send me, that's just technical analysis speaks. If you want to send me an email to support a Trade Day, you could ask that question. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Please do remember, please remember, no trading 2 minutes before or 2 minutes after. Set an alert on your phones for 2.5 minutes before. No trading 2 minutes before and no 2 minutes after. Okay, make sure you close out positions. Make sure you close out of any working orders. And yeah, have a great trading day. Helmets and goggles at the ready for the non-farm payroll, the employment report, and then have a great weekend too. Take care. Stay safe.